The broadcast is now starting. All attendees are in listen-only mode.
Hello, ladies and gentlemen. My name is Joseph Novichkov, Senior Analyst at GDMfx. Welcome to our chart patterns webinar. Before we start with the actual webinar, I would like to address a few questions that were popping out 2 minutes ago, just on time at the webinar. I've been asked several times. To read them one more time the whole webinar and to make it a little bit more complicated. What I'm trying to say is not too complicated so you don't understand it, but a little bit in more details for those formations that we're actually witnessing every day on our charts. One thing that gets me thinking, because so many people were actually wanting to make this webinar a bit more complicated, into our YouTube channel, ladies and gentlemen, bear in mind, we will still have our previous version of the webinar, so you can have both versions. The one which is a little bit easier to understand, which is a bit shorter version of the webinar, and today's version, which is a bit more extensive towards a level of understanding that you can actually have even the smallest things that can actually rock your boat. Now, before too much time loss, I would like to start right away, basically because it's a lot to cover. In today's webinar, we will start with the first chart pattern, which is the double top. Now, before I proceed, whatever questions you might have from today's topic or whatever topic that there is, please put them into the chat. I'll make sure each and one of those questions are going to be addressed after the session itself in the QA version of the webinar. Also, whatever questions are not relevant to today's topic, I will make sure I will address them in an email shortly after the session. And one more time, the recording of today's session will be uploaded in our YouTube channel. Visit it, watch the videos, and review whatever you have missed. Starting with the double top formation, the double top, of course, and on the other hand, the double bottom, those two are a pair of well-known chart patterns whose name, of course, don't leave much to imagine. Basically, they speak for themselves. These two reversal patterns illustrated a currency pair attempt to continue an existing trend. Now, upon several attempts to move higher, the trend is reversed and a new trend begins. Now, these chart patterns formed will often resemble as going to be, they're going to look as the letter M as a double top formation, the one that you see right now, and the letter W for a double bottom, the one that you see right now. Okay, the double top formation is found at where the peaks of an uptrend and is clear sign that the preceding uptrend is weakening, and then the buyers are losing interest. So upon completion of this pattern, the trend is considered to be reversed, and the currency pair or the commodity that you're trading is expected to move lower. Now, the first stage of this pattern is the creation of a new high during an upward trend, which after peaking, of course, faces resistance and sells off to a level of support. The next stage of this pattern will see the price starts to move back towards the level of resistance found in the previous run. And we are talking about the previous run up, which again sells off back to the support level. Then the pattern is completed when the currency pair falls below or breaks down, as we otherwise put it, you know, the support level that had backstop each move that a particular currency pair has made, it's making the beginning of a downtrend. Now, the importance to note is that the price does not need to touch the level of resistance, but should close to the previous break. And this is exactly where the neckline is. It's what you see on your screens right now. So trading before the signal is formed, of course, can shout a disastrous result. Now, as the pattern is only setting up, the possibility for the trend reversal and could of course invalidate this particular formation. Now, this pattern is a clear illustration of a battle between buyers and sellers, right? The buyers are attempting to push the price higher, but of course are facing some kind of a resistance, which makes, of course, which prevents the continuation of the upward trend. After this goes on a couple of times, the buyers, of course, they start giving up, or in other words said, they start drying out, and the sellers are starting to take a strength of that particular currency pair, sending it down into a new downtrend. Now again, the volume should be a very important focus, as one trader should look for an increase in volume when the currency pair falls below the support level. Also, it is other chart pattern, of course, they do not be, how to put it, alarmed, or another chart pattern does not appear out of this whole bunch of candlesticks, so it can be formed a new kind of trend. Now, the ones that you look right now, the double top, okay, as we can see here from the illustration, we have one top, pretty much the same level, another top. Bear in mind, sometimes double tops are formed even if the price continues slightly higher, let's say, but it still results as a double top formation. And the only way for this formation to confirm is only if it confirms below this neckline. And the neckline represents the far lowest price between the two tops, which is, of course, one of those two candlesticks, or both of them, or only one. This is where the neckline is. And one more time, by measuring the absolute potential of this type of position, if you want to open, is the size between the two tops and the far smaller top. Let's say the first top is the smallest one, so we have the price between the tops, the lowest price between the tops, up to the smallest top is by far the absolute potential for a downside when this formation confirms. Now, this is the rule that you, ladies and gentlemen, need to remember. The absolute potential. That means it could be smaller. That's why when you are trading, I have numerous of times have repeated myself by saying sometimes you might need to put your take profit a little bit higher if you're trading a double top. Let's say 5 pips, let's say higher than the absolute potential. Please consider you have a spread between the buying and selling price. That's one thing that you need to consider. And a few more pips just to be sure that your take profit is going to be hit. And as all of us, we're trading on MetaTrader 4, when we're setting up stop loss and take profit, as we mentioned into our intro to MetaTrader 4, when the stop loss or take profit is near, the price highlights in red or green regarding the direction of the price. So the next one to continue is the double bottom formation. Now I see a lot of questions, let me deviate a little bit. I see a lot of questions popping out. I do understand you might not understand everything. So I will manage to do so. Do not hesitate. Go ahead. Put up your questions. I will answer each and one of it after the session is concluded. So moving on to the double bottom formation. It is actually quite the opposite chart pattern. Okay, it's quite the opposite chart pattern than the double top, as it signals a reversal of a downtrend into an uptrend. Now this pattern will closely resemble as the shape of the letter W, the one that you see right now. Now the double bottom is formed when a downtrend sets a new low in the price movement. This downward movement will find a support which prevents the currency pair or the commodity or the index, whatever that you're trading. It actually goes absolutely the same for every each and one of it, instrument that you have on your MetaTrader. So when this downward move finds a support, that prevents the currency pair from moving lower. Upon finding that support, the currency pair or the commodity will rally to a new high, which is formed as a resistance point. This is exactly what we're talking, that this is the neckline. The next stage of this pattern is another sell-off of the price. That takes that particular instrument down to the previous low, or even a little bit lower. As we mentioned, it could be lower or higher, it doesn't really matter. It is the same formation and the same rules apply. Now, these two support tests which are formed, the two bottoms in the chart pattern, they will resemble our double tops, okay? But again, if this particular currency pair that you're trading finds a support and heads back up, the pattern is confirmed only when the price is above the resistance that the current instrument is facing on the prior up move. This is our neckline. One more time, it is concluded to be a double bottom formation only when we have the price above the neckline. When the price closes above the neckline, then we can have a bullish break of our neckline, and then we have a confirmed double bottom. When this formation confirmed, a trader might consider a long position. Now remember that the current instrument needs to break through the support line to signal a reversal in a downtrend. And of course, one more time I have to tell you, mind the volume. It should be a high volume. As in the double top formation that we mentioned earlier, do not be surprised if, of course, the price returns to the breakout point to test the new support level in the new downtrend. It could happen. This is called an invalidation of a pattern. But yet again, that is why we have our neckline, for us to confirm that this is a double bottom formation, or if it's a downtrend, it's a double top formation. Something that needs for you to mind about those two formations, it's important to get an idea as to the size of the resulting move. Once the signal has been confirmed in both double top and double bottom, the initial price objective could be measured by taking the price distance between the support and resistance levels, or the range that this particular chart pattern trades. The one that we mentioned earlier, you have to measure the absolute potential between the double tops. That is going to be the highest price right now. That is our resistance level. We have to measure it from here to our smallest in price double, smallest in price bottom. So let's consider that it's the first one, okay? And that means the absolute potential for this formation is going to be the distance between this and this point. to the upside. So when we're measuring, the absolute potential should be, let's say, that much. All right. Now, another problem that can occur in the second testing point. This is pretty much where the breaking of the line is. This is somewhere here, let's say. The problem that can occur is where the top or bottom actually breaks the level that the first top of the bottom tests a new creation point. Now, if this occurs, that can give us a signal that the previous trend will continue instead of a reverse. So, as that pattern suggests, we will not have a double bottom formation, so we must not be too quick to, opening a position, or on another hand, if the price faces another resistance, we should not be very quick to abandon the pattern itself, because it still can confirm in time. Now, if the price, in fact, move above the previous test zone, which is the resistance level or the neckline, you have to look to the chart and see if the move was accompanied by a large volume, suggesting a trend continuation. For example, if the second test of the double bottom, the price falls below the support line on heavy volume, it is a good sign that the downtrend will continue and not reverse. That means we will not have a double bottom formation. All right. Now, those are the points I would like to stress out on, because it's very good when we have a confirmed double bottom or double top formation, but what would happen if the whole formation starts invalidating? We need to be prepared for the worst case scenario, which we might make a mistake yet again and enter in this particular moment, let's say a long position somewhere around this point, and the price doesn't confirm and it starts falling down on a large volume. That's why, as an experienced trader, I would recommend, that's what I would do, of course, to wait at least one more candlestick to close above that price and support itself on the neckline, which is actually the previous resistance. Now it's going to be a support line. This is the level from where we are actually going to consider our long positions. Okay, so far so good. The double tops and double bottoms are very strong reversal patterns, as we already mentioned. It can be visible on all charts. It provides a great trading opportunities, especially, ladies and gentlemen, let me tell you, especially if you are looking at a higher time frame above 4-hour chart. Now, 4-hour chart, daily chart, weekly, and a monthly chart on your MetaTrader 4, you need to consider that those formations are extremely powerful. Those rules apply even for the next ones, for the next formations that we're going to look for, and we are going to continue with the head and shoulders. Now, the head and shoulders is one of the most popular and reliable chart patterns into the technical analysis. And of course, it's one that, of course, we don't need to imagine where the name comes from. We should only look at the chart and decide why it is called that way. It has a resemblance to the double top and double bottom formation. Right now we have a head and shoulders. We have one shoulder over here, which is a lot of candlesticks in a group, one next to each other, forming one shoulder. Then we have a second group of candlesticks that are actually forming our head, all right? And if a second shoulder on the right side of that head appears, that's the second shoulder, and then we can consider that this could be, and I can underline here, could be a head and shoulders formation. Yet again, we needed to confirm below the neckline. And something that I need to add to the whole presentation today, ladies and gentlemen, bear in mind the lowest points that you need to get, or the highest points, regardless of the formation. Please consider not only the closing price, but the shadows themselves. Now there, the shadows, they're hiding the greater risk. That's from where you should count your highest and lowest point. So the head and shoulders is a top reversal pattern when the price is set to fall. Once the pattern is complete and is usually formed at the peak of an uptrend, of course, the trader should mind that the potential, one more time, is between the top of the head and the neckline itself. And should remind you one more time, ladies and gentlemen, the neckline is very important. That is where we have to wait our price to confirm. One more time, if you please, wait for a second candlestick to close below that neckline. Sometimes the volume is so great that the formation is fulfilled with only a few moves, let's say, or one session. In that kind of a case, there is nothing we can do about it. It's just confirmed. People have taken their profits, and we should not enter one more time, basically, because it could be over. So the second version of the head and shoulders is also known as reverse head and shoulders. Okay, both of these head and shoulder formations have similar construction. We're going to take a look at the second one later on. In that there are four main parts of the head and shoulder chart pattern. Two shoulders, as you mentioned, a head, and a neckline. Now the patterns are confirmed one more time when the neckline is broken after the formation of the second shoulder. The head and the shoulders are set of a peak and throats, okay? The neckline is a level of support and resistance. The head and shoulders pattern is based, of course, on Mr. Dow Jones theory, peak and throat analysis. Okay, and an uptrend, for example, is seen as a period of successive rising peaks and rising throws. Okay, a downtrend, on the other hand, is a period of falling peaks and troughs. Now, the head and shoulders pattern here illustrates a weakening in trend where there is a deterioration in the peak and troughs. Okay, now this is very important to remember. We have four different important lines here to remember, four different points to remember. Two shoulders, one head, and a neckline. Now, instead of the double top and double bottom formation, when we actually had only three, okay, we add another one, which is one more shoulder. So it can appear as a head and shoulder formation. That makes it even stronger reversal pattern. Again, the head and shoulders is a top signal to the chart users that a price is likely to make a downward move, especially after it breaks below the neckline of the pattern. Now, due to the pattern forming mostly at the peaks of an uptrend, it is considered to be a trend reversal pattern as the price heads down after the pattern's completion. So even though we might witness a magnitude of 2 to 3 times the absolute potential of this position, okay, 2 to 3 times bigger. That's how strong this kind of formation is. Okay, now for this pattern has one more time the second step that it needs to be formed after the head is done. There is when the price reaches higher again, then retraces back, then lower and forming the left shoulder. Those steps are the formation of the right shoulder. And one more time, this is our complete head and shoulder formations. So when it confirms below the neckline, then we can consider our positions and the opportunity from the whole formation, the absolute potential of it. When we have to consider that if the previous trend was very strong and this formation occurs on an uptrend, that could be a trend reversal formation which can result in the full 100% magnitude of the previous trend. Okay. So far so good for the head and shoulders. Let's move to the reverse head and shoulders. It's pretty much the same, a mirror look of the previous formation. The reverse head and shoulders pattern is exactly the opposite of the head and shoulders top, as it signals that the price is set to make an up move. Often it's coming at an end of a downtrend one more time. The reverse head and shoulders is considered to be a reversal pattern one more time, as the price typically heads higher after the completion of the pattern. Now, one more time, after the all of the 4 steps are considered done, the creation of the one shoulder. After that, the resistance where we're going to have our neckline, and then the creation of the head. One more time, the price will break above, so it can reach the neckline, tries to break above it, but faces a resistance one more time. Then the second shoulder is created. Then we have our 4th point when we have our created reverse head and shoulders. And to confirm the full formation, right then, the next time the price should break above the neckline, which is the previous so-called resistance level, and then forming it as a support. Right then, when the second candlestick of it closes above it and supports itself on the neckline, then we can consider buying position. The breaking of the neckline, ladies and gentlemen, gives a potential of a return move. So it often results in the price slamming back down again, to retest those levels one more time. This is the most important part of those formations. One should not rush into buying or selling if the formation is clear. Sometimes, even I would add, much more often, the price is actually breaking below one more time only to confirm a support level. That is where you will get a better price to enter. In this particular formation, a better at a lower price, so you can even sell on a higher price. And if we're having a normal head and shoulders, you will get a higher price close to the neckline, which will give you a bit more profit potential. So that is, those are the key points a trader should remember. When the formation is completed, wait for a slight retrace and then enter. That's going to give you a better opportunity on the market. This is how I'm making my profits. Pure calculation and strong nerves, of course, because sometimes those kind of formations, ladies and gentlemen, they're very, very nerving, especially if you're waiting for them to confirm for a long time. And if you're looking at a 4-hour chart and the head and shoulders formation is a very huge one with a profit potential with more than 200-300 pips, now this is something we should very, very cautious about it. So now the next thing we're going to pay attention to right now is the volume of this formation one more time. It's very important. In the technical analysis, the chart pattern analysis, volumes are playing an important role as it's used as a secondary indicator. So when you are trading on a high volume charts, high volatility instruments, let's put it that way, you have to have your volume indicator on your chart always to measure the volume, because it's a very important, it plays a very important role. Now, volume indicates activity and money movement. When volumes are high, there is a lot of activity and the money is changing hands, making it as an important indicator to follow. For the head and shoulders pattern, ladies and gentlemen, volume is used mainly at the point of breakout to help confirm the pattern. Now, at this point, it's important that the breakout happens on a large volume moves. For a head and shoulders top, when the price breaks below the neckline in a downward direction, let me put it that way, it's best when this occurs during a large volume increase. That is going to indicate a signal for a very, very heavy selling. This strongly indicates that the underlying applies and the demand in the market is moving in the same direction that the chart pattern is predicting. All right, this is very important to remember, a key point. Volume can also be used as a secondary indicator during the formation of the pattern, well before the breakout, to gain an idea of the pattern strength, of course. That is why we need the volume. For a head and shoulders top, the left shoulder should show heavy volume as it hits its new peak. Okay. Low volume, on the other hand, should be taken for the left shoulder as down to the neckline. Okay, that's when we should see the low volume. The run towards the peak, of course, in the heady shoulders should be on a lighter volume compared to the peak formed in the left shoulder. This should be a warning, ladies and gentlemen, as the volume should move with trends, not against them. It's very logical. Now, the peak formed in the right shoulder should be seen as with even lighter volume than in the either the head or the left shoulder, of course. And again, the volume should be high when the neckline is broken. One more time. It should be moving towards the new trend, which is by far the most important area to watch in terms of the volume itself. So the interaction for the volume and the price movement in forming the reverse, reversal signal is of course not written in stone, let's put it that way. It's not necessary to be that way. However, it is the general tendency in the chart pattern. Now, the slope of the neckline, this is another key indicator, key factor, if you wish to put it that way, in the head and shoulders pattern, that it's a formation for the neckline. The reason being that the neckline acts as a support or resistance during the formation of the pattern, along with being the entry point at which the pattern confirms itself. Now, those kind of key points, ladies and gentlemen, sometimes when you have the time to review this recording on the YouTube channel one more time, please put it out on a piece of paper. See if you can, fit it in as a few rules while you're trading those formations. Because basically, when you face some kind of difficulty sometimes, you will find out exactly where you're mistaken, because you're breaking one of the rules of those formations. And those formations, a mathematical pattern that is actually showing whatever happens in the past will happen in the future again. Now, the price objectives are always also important, but they're very often overlooked. Now, factoring technical analysis and chart patterns is the calculation of price objectives. Those are the key points that we were talking about when we were saying price potential. Now, while the price direction is already known based on the signal, right, what we need to calculate is the projected price movement. This is the price potential. Whether it's a reverse head and shoulders to the upside or it's a head and shoulders to the downside, the price potential is very important. Now, this is only set. Let me put it another way said, so you can understand why it's so important. It is done so the targets can be set, of course, regardless whether it's going to be stop loss or take profit. It's always for your protection, for protecting your own investment. And this is one more key point you should write down or print it out. Put it next to your screen when you're trading. Do not forget to follow it. Because if you're waiting too long and the price is already confirmed and the formation is already fulfilled, most likely the price will return to the upside or to the downside, wiping your profits, bringing it to the zero, and unluckily you have wasted a lot of time configuring whether this is the right choice for you to do, but overlooking this very small stone on the road, it's actually turning your car upside down. That is why it's so very important. Now, so far so good for those head and shoulders and double tops formations. There are formations which are seen on the chart that resembles as a triangle. So the first triangle that we're going to take a look at is the symmetrical triangle. This is also a very key and very important formation, mainly because when the price is narrowing down towards the smallest angle of that triangle, a break off from one of the sides of the triangle will set the stage for the new move and the direction of it. How to calculate the potential of such positions? It's very easy. They have more than one potential, and it's a little bit more complicated to trade them, basically because they have too much potentials. So you need to, let's say, open a position with, just an example, 3 lots, and then you have 3 targets. If the triangle is very big, and let's say you have more than 5-6 support resistance levels, then you have to trade with 5 to 6 lots. For example, you can trade with 0.06, let's say. That's only up to you. Basically, it has to be connected to the size of your account. You need to equalize all those positions. Now, that's something that we're going to talk about in our FX risk management, our future webinars. Symmetrical triangle, the symmetrical triangle is mainly considered to be a continuation pattern. Now, that signals a period of consolidation in a trend followed by a resumption of the prior trend. Okay, it is formed by the covering of descending resistance line and the ascending support line. Now, the 2 trend lines in the formation of this triangle should have a similar slope, meaning that point to know is that the triangle should be a symmetrical one for it to appear as a symmetrical triangle. Now, if preceded, of course, by a downtrend, this type of triangle focuses on a break below the ascending support line. Now, if preceded by an uptrend, one more time, look for a break above the descending resistance line. However, this pattern doesn't always lead to a continuation of the previous trend. On the other hand, a break in the opposite direction of the previous trend should signal that the formation that is forming a new trend. So if it's been an uptrend and the price breaks below the support line, that means it's going to form a downtrend. But if, of course, it breaks above the ascending trend line, the one that you see over here, above the ascending trend line, that means it is a continuation. That's why those triangles are very important, because after a consolidation and the price is narrowing down to a very tight angle, a breakoff is imminent, but at which direction? That is why you need to wait for a confirmation. It has to confirm with at least 2 candlesticks closing above or below the support line. And saying the support line, that means the falling, the short-term downtrend line or the short-term uptrend line, which is actually concluded the triangle in between. So as we have explained already about this type of a symmetrical triangle that is preceded by an uptrend, the first part of the pattern is the creation of a high and the uptrend, which is followed by a sell-off to a low point one more time. The price then moves to another high that is, of course, lower than the first high, and again sells off to a low, right? Which is, one more time, the next low is higher than the previous low. So at this point, the triangle can be drawn which creates that shape of a triangle. Now the price will continue to move between these lines until a breakout. Now the pattern is complete when the price breaks out of the triangle. Look for an increase in the volume in the direction of the breakout. One more time, we're putting out the volume as a key indicator into our trading symmetrical triangle, double top, double bottom, head and shoulders, reverse head and shoulders. For every one of those formations, you need to look for the volume to be in the same direction that you're looking this trend, this formation to confirm. That's the key point. This pattern, ladies and gentlemen, is also some of the traders are skeptical about it. Let's say they don't really recognize it, or even if they do, they don't know what to do with it. And it's quite powerful, to be honest with you, because after a large volume, after a directional move, let's say a trend, the price starts to consolidate and consolidate between two trend lines, one up and one down, until a breakout with a large volume. Then we can conclude where is going to be the direction of this symmetrical triangle. On another hand, ladies and gentlemen, we have two more different triangles which are also very important, but those two types of triangles are preset in a direction. So the next one we're going to take a look at is going to be our ascending triangle. Now that is a very curious key to remember. We have our symmetrical triangle, right? The two declining, the two trend lines, one declining, one upwards, are actually with one and the same angle or very close to it. Then we can expect the break off from those lines either direction. But right now in the ascending triangle, it is a bullish pattern, which gives an indication that the price of that particular currency pair or commodity that you're trading is headed higher upon completion. Now the pattern is formed by two trend lines. One more time. A flat trend line that is being a point of resistance and an ascending trend line that is acting as a support price. Now what you see here, one more time, we have our flat or sideways line that is acting as a resistance where we should look for a break off, and it's absolutely flat. All right, it could be on a slight angle, but we prefer to have it absolutely flat, basically because then it's a perfect ascending triangle. And the other one is in an angle, as you can see over here. We have our up movement trend line, which is acting as a support of the price. And the price of this kind of commodity or a currency pair moves between those lines. Until it moves between those lines, it eventually breaks out of the uptrend, out of the upper line. Okay, breaks above, and this pattern will typically be preceded by an upward trend, which is making it as a continuation pattern. However, it can be found during a downtrend. It is also very common. We've seen that in many commodities, especially including gold, because it's one of the most volatile units. Unluckily, for the past 1 week, the narrowing of the price between two levels, that it's about $11, is actually making it one of the lowest volumes on the market so far. But thanks to the news these days that we had yesterday and the numbers that came out right now, we're having even a bigger volume, which makes the investors very happy. So this type of triangle, as seen in the presentation picture right now, the price moves to high that faces resistance, leading to a sell-off to a low. This follows another move higher, which tests the previous level of a resistance. Okay, upon failing to move past these levels of resistance, the price again sells off, but to a higher low, which sets the continuation until the price moves above the level of resistance of this pattern. And again, if it fails, it will move down to a new higher low. That is setting the contraction of a price into one very close point where we can expect our breakoff. The pattern is completed, ladies and gentlemen, upon a breakout above the resistance level, but it can fall below the support line. That is going to result in an invalidation of the pattern. So far so good about this ascending triangle. We know that if it fails to confirm, and if it breaks below this support line, which is an uptrend move, okay, that is going to result in invalidation of the triangle pattern, and we should consider it as a fake signal. So the ascending triangle points that the price should break above. The descending triangle, on the other hand, is quite the opposite, and it's pointing that the price should go down. Now the descending triangle, as we already seen from the picture, it's the opposite of the ascending triangle, and that gives us a bearish signal to our chart analysts or to you traders out there. So that suggests that the price will trend downwards upon the completion of this pattern. One more time, we have to see it confirm below that resistance level. The descending triangle is constructed with, one more time, a flat line, which is right now the support line, and a downward sloping resistance line, one more time, which is the resistance this time. Okay, similar to the ascending triangle, this pattern is generally considered to be a continuation pattern, as it is preceded by a downwards a trend line, but yet again it can be seen into an uptrend. So that is where you should kind of, consider this as a rule that can be broken. So you can find it most commonly in a downtrend, but is seen on an uptrend as well, which is actually very powerful if you see it that way. Okay, the first part of this pattern is the fall to a low that then finds a level of support, which sends the price to a higher level. The next move, of course, is a second test of the previous support level. One more time, that's the flat line below, which is again sent to a new higher level, a new higher price, which creates the falling, this descending trend line, which is going to shape our full triangle. The pattern indicates that the buyers are trying to take the opportunity to break the market higher, but the buyers are fading away very, very fast, and the sellers are taking charge and then sends the price lower. When this confirms, we can say that the triangle is fulfilled and we have our breakthrough, so we can consider our positions. Now, talking about the potential of this type of triangles, you should find where are the previous highs and lows. Now, if we have the descending triangle, let me highlight it for you. It's easier for you to see. If we're talking about the descending triangles right now, okay, you can see that when the price breaks below, whether it's a very small candlestick here and then followed by another one, another one, another one, or just with a very huge volume one candlestick, still the first potential is the lowest low point of this formation. Okay? Now, if we had this shadow right here, let's say, okay, this should be your next potential target. So when you're setting your targets, let's say you're trading with 3 lots, okay, you have 3 lots position, you have to set your first take profit over here. That's going to result in a volume that you're going to close your position with bigger than 1 lot size, because you need to take as much as possible out of this position, because next target might not confirm, let's say. The price can head higher one more time. So we consider closing that position with at least half of this size. Let's say you're closing your first TP, let's put it that way, with 1.5 lots. Okay, the next potential target, if you have a third shadow which is even lower, this is your third TP here. Okay, so this position you should consider closing with more than 50% of what is left into your position. So we had 1.5 lots closed. Now we have 1.5 lots left into our position. So we are closing the second target with 1 lot. So what is left for the third one is 0.5, mainly because we never know if it's going to be a third target. But those types of formations, ladies and gentlemen, they result in a very huge continuation. So that's why they're traded that way. You have multiple size of your position, right? More than 1 lot or more than 0.1 lot. So you can consider first target, second target, third target, and if you have 10 targets, then you can consider them as well. But be mindful always to close more than half of the position every time you're closing, basically because you might have not an opportunity to take more from this type of formation. On the other hand, when you're setting up your stop loss, it should be yet again a few pips higher than the closing of that price. Okay, now we're talking about the closings. Well, I hope I have been very helpful with those type of formations. I've tried to make them a little bit, more in details why that happens and why it confirms and why it's going to happen one more time. Basically, a lot of traders are looking for those types of formations, and that's exactly what they're expecting from the market. Well, ladies and gentlemen, I can see that we have about 5 minutes to the hour. That gives us an opportunity to conclude a few questions in our QA session, because that is pretty much the last of the formations that we're going to take a look at today. So consider your questions. I'm going to give you 5 minutes so we can start answering them, because I can see your questions are flowing in since the beginning of the webinar itself. So I'm giving you a few minutes. Consider those questions, and I'll be back with the QA session. Thanks for joining. All right, ladies and gentlemen, welcome back to the QA session. So basically, the questions that I've kept receiving are pretty much, we have like 10 different, 10 questions which are actually pretty much the same, so I'm going to answer each and one of it. People keep asking me whether this is applicable to let's say gold, USD JPY if you wish, New Zealand dollar against the Swiss franc if you wish. Those patterns, ladies and gentlemen, they are applicable on every chart. It doesn't matter what kind of instrument you're trading. Whatever that you want to trade, you can see those formations as well. And as you can see on your screen right now, the next webinar, which is candlestick formations, next week, it is going to cover in a little bit more details how you can recognize other types of patterns. Basically, all of this applies for the for all charts. Those formations apply for all charts without exceptions. So another question that I've been asked, if whatever I explained in the beginning, people should wait until the price breaks the neckline and only then open a new position. Well, that is actually the one thing that confirms that chart formation, right? The neckline. This is pretty much from a break off and closing of the next candlestick above or below that kind of a neckline gives you an opportunity to know that this formation is confirmed. That is where you should buy or sell, regardless of the direction in the formation that you're facing on. Okay? So another question going forward, based on the chart, the question is about the head and shoulders formations. How sure I am that about the trend and its future? How sure I am about the next trend? Well, ladies and gentlemen, let's scroll a little bit backwards, okay? Let's head straight to the beginning itself. Double top formation. It is obvious that it's suggesting that if the formation itself is confirmed below the neckline, it's suggesting a downwards movement. So, weren't you going to be absolutely sure that the price is going to go down? Of course you will be. So that's how I'm sure that the price is going to go down on a double top formation. Let's take a look at the double bottom formation. It's the same deal, but the opposite. Two bottoms, one neckline. Three key points to remember. When the price breaks above the neckline, there you go. You have your confirmation that the price will head up. Now, it might not be a trend, but the price will confirm with the same potential as we mentioned earlier, right? That's what we're looking for. Regardless on the time frame that you're trading, ladies and gentlemen, if you're trading on for one-day chart, let's say 4-hour chart, one-day chart, weekly chart, and so on, of course your profit potential is bigger. That's what is very important to remember. If you're trading on a 15-minute chart and you're trading gold, for example, and this kind of formation appears in front of you with a potential of just $1 or $2, this is pretty much what you're going to get from it because it's a 15-minute chart. When you're looking at a bigger picture, it's a bigger profit-loss potential. But we're looking at a smaller picture, it's a smaller profit-loss potential. That is what it is. Another question I got here about regarding the relative strength index. Now, even if I explain to you what that means, some of you might know, of course, but one thing to remember, we are going to cover the relative strength index as well. One of our attendees would like to know how to determine the trends of the head and shoulders formation. It's obvious that most of the questions that I'm getting is about the most powerful formation right now, and that's the head and shoulders and reverse head and shoulders. And to be honest with you, it's a bit tricky with these formations because sometimes a person might think that this is a formation that it's head and shoulders. There are a few rules that apply here. Those that were mentioned earlier, put them down on a piece of paper and follow them. Otherwise, it's not going to be a head and shoulder formation. So please, ladies and gentlemen, follow those rules. They're very, very important. All right. Now, next thing, people keep asking me about the volume indicator. It's pretty much something that you can put or remove on the chart. It's not an indicator. It's basically something like, you know, the grid on the chart, the period separators, and so on and so on. The volume indicator is actually a undetachable part of one's trading chart. That's something that gives you an idea about money flow, and this is what's more important than anything else when you're trading those formations. Of course, if you're trading candlestick formations, you know, candlestick patterns, and so on and so on, those volumes are not the volume indicator is not such does not play such a huge role, basically because we're talking about small time frames, and if you're looking at a bigger picture, still the volume is going to be with the same size. The only difference is that you're looking at, let's say, daily chart or a weekly chart, and so on and so on. The volume is creating a powerful continuation move, so that is why you need to look at it when you're trading those formations on the chart, because it gives you an idea whether the next move, which is going to be in your direction, whether it's going to set up a new trend or it's the continuation to the old one, it's still going to give you an idea that the next move is going to be powerful, and until it reaches a certain peak where it's going to resist and is going to start heading backwards and retreat a little bit. Okay, so far so good. I've got a lot of questions one more time about those one-on-one meetings. Not a problem, but please, I would kindly ask you not to do it from the chat. You all have my emails, or go into our website, contact our support agents. They will contact with me directly and set up meetings for each and one of you guys. I have time, not a problem, but we need to schedule that up because otherwise it's going to be a mess. And yet again, those questions which are not relevant to the topic, expect the answers as soon as in the next 15 to 30 minutes, as soon as I complete all of the answers. I will be available for one-on-one sessions one more time. Thank you for joining us today. It was a great pleasure for me to present those formations. Please don't forget to sign up for the next webinar. It's going to be very educational, and it's going to help you furthermore with your trading. It was a pleasure for me, Joseph Novichkov, Senior Analyst at GDMfx. Goodbye.